Iris Chiu has been a corporate law and financial regulation professor at UCL. As an academic member of the Center for Ethics and Law, she promotes public and stakeholder engagement on issues related to the law and regulation of the banking, financial, and fintech sectors, the crypto economy, and broader business governance.
I leave the floor. Thanks for joining us, even if from London. How was the weather in London?
Not warm at the moment. I think we are 13 to 14 degrees, so still waiting for spring.
Okay, so better in Florence, at least for the weather. Thank you, Cyrus. I leave you the floor. Thank you.
Right, thank you, everyone. My name is Iris Chiu, and I hold the chair of Corporate Law and Financial Regulation at UCL. I'm very grateful to the organizers of this conference for allowing me to present this remotely. I have personal reasons for not being able to travel much, and I've therefore missed the opportunity to engage with you. But please feel free to reach out to me via my institution email on this slide, and I hope very much to continue our conversations as you might be interested in whatever I have to present. So today's keynote address, I've titled it, Would MiCAR Snuff Out the Global Stablecoin? It's a slightly provocative title, and hopefully I'll take you through my analysis, which I hope you may find to be of interest. So first, let me congratulate Professors Zati and Baresi for their excellent volume on digital assets and the law. And my address today is focused on stable coins as a type of digital assets. And the paper that I'll be basing on is my recently published work, which I'll be introducing in a second. But basically, I will critically ask if the FSB policies, that is the Financial Stability Board's recommendations for regulating stable coins and MiCAR's regulation is of a nature that enables the industry or disincentivizes the industry, or a mixture, and to extend to, what extent in each way. And in particular, I would like to draw your attention to a quote from an FCA policy officer, Enrico Rossi, wrote in 2022 that stablecoins are lumped together as a group because of its technical features, mainly because they are purported to be pegged to a fiat currency or one or more fiat currencies, and they usually have some collateral backing. However, there are actually many different users of stablecoins, and the typologies of stablecoins are rather varied. And it is a question whether regulation has managed to capture all of these differences and to bring about a regime that is suitable. So my address will be based on this paper. The title is Global Stablecoins Without a Future, Analyzing Europe's Regulatory Defense in the Markets for Crypto Assets Regulation as an Internationally Leading Example. So this paper is forthcoming in the International Lawyer, which is a journal published by the American Bar Association. So I've been informed that they will publish it in May. So I'm not sure if it is out yet or is going to be out, but it is hopefully very imminent. MiCAR stablecoin regulation is a regime that includes all types of stablecoins. As long as there is a reference to one or more fiat currencies, that kind of stablecoin will fall within the regulatory regime of MiCAR. So basically, the regulation for stablecoins is built upon a framework that is targeted at a type of stablecoin called the global stablecoin. The global stablecoin is defined as being pegged to one or more fiat currencies, usually stabilized by reserves or collateral backing, and intended for cross-border transfer or international remittance. So this definition was adopted by the Financial Stability Board in its 2019 and 2023 papers. Now, my paper argued that the regulation in MiCAR, which is based on the FSB's recommendations, is based on some laudable good public interest objectives. However, the fact is that it is very likely to be highly disincentivizing for significant developments and innovations in the area of the global stablecoin business model. And I don't think we are seeing very significant projects at the moment since the demise of the DM project that Facebook/Meta was proposing a number of years ago. However, many existing stablecoins that are in circulation are much more limited in terms of their functions. They work mainly as gateways to cryptocurrency purchases, and they are only able to work on the permissionless blockchains that they are programmed for. And in other words, the way these stablecoins work are not really compatible with real mainstream kind of commercial users, payment systems, and remittance. And these stablecoins in the paper I call gateway stablecoins. The paper argues that many aspects of MiCAR are either going to be over-inclusive or under-inclusive for gateway stablecoin because they are essentially designed for global stablecoins, and gateway stablecoins are not actually quite the same. So in terms of the universe of stablecoins, a very brief introduction here is that the most popular stablecoins that are in circulation today are gateway stablecoins. They usually purport to maintain a stability of value, but this stability of value is what I call relative stability, not absolute stability. Gateway stablecoins are used mainly as stores of value for cryptocurrency holders because cryptocurrency is highly volatile and many cryptocurrency holders prefer to hold stable coins because they are relatively more stable and they provide an easy conversion into cryptocurrency in order for users to then carry out transactions or activities on permissionless blockchains. And those activities and transactions on those blockchains are settled in the native currency of the blockchains, which is the cryptocurrency that is programmed for the chain. There's another type of stablecoin that some innovators have tried to develop for these permissionless blockchains, and they are called algorithmic stablecoins. They are experimental in nature, and developers try to use modeling in terms of behavioral economics and adjustments in supply and demand protocols in order to maintain relative stability of value for these algorithmic stablecoins. But they are usually not backed by reserves. And to date, many of these experiments have either not been successful or the coins are definitely not trading at par with the US dollar. Some of them are trading at a few cents, for example. So in terms of being a stable coin that's widely adopted by cryptocurrency holders, many of these projects have not been successful. And then more broadly speaking, kind of beyond the stablecoin universe, but it's a matter of definition, are tokenized financial assets, instruments, or tokenized representations of value that we may call money. And these are more broadly just digitalized versions of bearer value instruments. And some of them are designed to be transacted in web peer-to-peer type interfaces. So that is a broader conception beyond the stablecoin definition that we see adopted in the FSB or under the regulation in MiCAR. But it is a continuum in terms of understanding what these digitalized representations of financial instruments or value intend to do. And they are intended to represent value, sometimes a relative stability in value, and to also mobilize exchange and liquidity. Now, one example of this sort of alternative, innovative, tokenized representation of a financial instrument would be something like Paxos Gold or Tether Gold. These are tokenized representations of value that are backed by gold. And so holders will be able to redeem these for gold, as well as hopefully use these as exchange instruments of value. Now, in essence, what is the demand or what is the innovative value of these tokenized, digitalized representations of bearer money or financial assets? Now, these are privately issued, and their innovative value lies in supporting peer-to-peer Web3 transactions. And at a level of innovation, because they are bearer in nature and they support peer-to-peer transactions, they have the potential to bypass existing account-based transfer and settlement architecture. And we could say that conventional transfer and settlement architecture usually takes a bit of time. And these real-time bearer-based transfers may increase in efficiency in terms of achieving speedier real-time delivery versus payment. So this is the kind of innovative value that we are looking at, if we allow these innovations to be mobilized and see what they can offer. So they can be rather disruptive. However, for them to be very successful, they will need to build out network effects as well as social trust. And one of the crucial issues underlying social trust is that these instruments tend to be privately issued, and privately issued instruments may suffer from market discounts in value because the market may not have full confidence in either the issuer's solvency or the financial stability. So privately issued instruments may be innovative in nature. They may meet a new type of payment and settlement need. However, there are issues considering whether or not the issuer itself can be trusted, whether they can mobilize to become collective goods for people to use them reliably. And it's these possibilities that have focused regulators' attention. So regulators' attention really is focused on the potential systemic kind of discounting or runs on these stable coins, and the risk that these privately issued tokens that purport to be money, purport to be stable in value, if they disappoint users and the network of users is significant, then we may experience systemic fallout effects if they don't function as promised. So despite the risks of this type of innovation, there has been a project that was very ambitious, raised by Meta, Facebook, called GM, which made regulators rather concerned. And that was the genesis of the stablecoin regulation designed by the Financial Stability Board and ultimately now found in MiCAR. But what is curious, of course, is that this very much discussed project ultimately did not take off. And we are not actually seeing alternative projects with this sort of scale or ambition in its wake. And a crucial question is whether the regulation itself might be strangling and disincentivizing. And so the balances in regulation really have to be considered, even if some of the public interest objectives that I have alluded to briefly, are very important. So in terms of Meta's project, it was initially called Libra, and then after that renamed as GM. And Libra's project was to issue a stable coin that would be able to exchange for many different global currencies and therefore had to be backed by different fiat currencies. And users on the vast Facebook platform could then transfer these tokens to each other internationally on a peer-to-peer basis, bypassing existing account-based transfer and settlement architecture. And this would revolutionize international remittance, providing a very disruptive alternative. So the vision and the idea could be very alternative, could be very disruptive in nature, but the project ultimately ran into many problems because it is inherently challenging for an alternative architecture to be built out internationally across Meta and Meta's various international partners. And the management of reserves against many different types of fiat currencies was also very challenging. So in the end, Meta confined its project to the US dollars, and it was meant to be only domestic. However, that did not receive the regulator's blessing, and Meta sold all GM-related assets to Silvergate Bank in 2022. And I think that is a sign of acknowledging that perhaps only a player in the banking industry, or perhaps the multinational banking industry, was best placed to carry out a global stablecoin project. However, Silvergate Bank, as many of us will know, was a casualty of the American bank crisis. It was liquidated in September 2024. And so the GM project is probably as good as dead in the water. So with all of these challenges, there is a question as to whether regulation should perhaps be more enabling in nature. But the reality is that the shape of regulation in MiCAR is much more defensive in nature. And what is it defensive about? It is defensive of the monetary sovereignty of the fiat currencies, of the euro, of member states' national currencies. It is also defensive of the singleness of money, that money-denominated instruments must be able to convert at par value. And implicit within such regulation is a skepticism that the private incentives to issue a collective good for global monetary use, such as a global stablecoin, are itself very questionable. That private incentives might not be trusted to provide a collective good that is stable and that will function predictably for users. And there might be conflicts between private incentives and the needs of collective good users. And so strong regulation is therefore needed to underpin the absolute stability of value of privately issued stablecoins. However, one has to bear in mind that empirically, we observe that gateway stablecoins, for example, have lost their pegs many times. And users or gateway stablecoin holders have not been completely turned off by the market. they have accepted a kind of relative stability rather than absolute stability. You might say that this may not apply to the global stablecoin when we apply at scale to conventional payments. So there is good reason why public interest objectives to underpin the absolute stability of value is important. That said, such regulation would, however, likely create disincentives for the major players, both banks and fintech, to develop global stablecoins. So this is just a slide to explain that specialist gateway stablecoins have lost their peg several times. In 2018, in 2022 for Tether, in 2023 for USDC, and these were temporary, and market confidence did recover after the initial depegging, and they remain quite highly market capitalized. So in other words, gateway stablecoins are treated by the holders in a slightly different way with different expectations. And therefore, there might be a disconnect between regulators' hypothetical concerns and users' concerns where gateway stablecoins are concerned. But gateway stablecoins are caught within MiCAR's regulation of stablecoins in the same way as global stablecoins. And the current landscape we have is that many gateway stablecoins find MiCAR to be rather ill-fitting, whereas global stablecoin projects have been very slow, if not stalled, and are very modest in nature and very conservative. And so there is a question for what regulatory policy intends, to achieve. Now, in terms of what are the disincentivizing features of regulation, I would first say a few words about why the global stablecoin is an inherently difficult business model. It is inherently difficult because privately issued tokenized money, in order to perform as a disruptive, innovative alternative, it will have to offer its own settlement and transfer architecture, which is more efficient and also secure and also reliable versus the account-based systems that we have built over the years, which is supported by the collective goods of international standardized messaging that SWIFT provides, and the central bank ultimate settlement system, in terms of banks holding their accounts to central banks and having transfers reconciled and settled that way. So a private architecture that rivals that is very difficult to build for private issuers, whether banks or fintech partnering, other international partners. And also, even if they build out an alternative architecture, tokenized money would still have to work with account-based money because users do not all convert or live on one system and not the other. So there still needs to be partnership and interoperability, which is very, very difficult. And even if all international partners are robustly regulated and they have fully backed very high levels of reserve regulation internationally will remain fragmented, because that is the case if we look at MiCAR's regulation as comparing to some of the US's proposed bills and the UK's discussion papers. There are slight differences in each jurisdiction's reserve regulation for stablecoins. So if we talk about a global stablecoin needing that kind of international partnership, coordination, and convergence, is inherently already very, very difficult. And in terms of MiCAR's regulation, it kind of exacerbates some of the difficulties that will be faced by a global stablecoin business model, partly because full reserve regulation, even though very attractive in public interest, creates certain disincentives. And I think both come simultaneously and concurrently. And it's a very difficult trade-off and dilemma. So I argue in the paper that for banks, reserve regulation for the issuance of global stablecoins will be very disincentivizing because reserve regulation sits on top of banks' existing capital and microprudential regulation, capital and liquidity regulation. And so reserve regulation adds an extra layer of cost. And banks would therefore prefer to intermediate deposits, such as tokenized versions of deposits and conventional payment services. It would be much more expensive for banks to develop global stablecoins as part of their remittance and transfer suite of tools. Further, MiCAR provides for narrower investment management possibilities in terms of the reserves backing each stablecoin than for e-money issuers. And so there are relative levels of unattractiveness engaging in this as a business model, not to mention that there are certain absolute caps on issuances. And the other key disincentivizing feature for both banks and fintech in MiCAR is that there is concurrent application of mandatory disclosure and merit vetting for stablecoin issuers, along with reserve regulation and prudential regulation. And this regime of mandatory disclosure for stablecoin issuers is unique to MiCAR because neither the UK proposals nor the US bills require this. And mandatory disclosure regulation presents a continuing legal risk for issuers because if the stablecoin has any functional problems or defects in due course and holders suffer inconvenience or loss, then they could always go back to mandatory disclosure in terms of promised benefits or functionality and mount a claim for defective disclosure. And so this leaves an open legal risk for designers and developers of stablecoins. So in other words, it's very likely that banks and fintech would find the e-money business to be much more attractive and less burdensome than the global stablecoin innovation. And for gateway stablecoins, MiCAR doesn't really map onto gateway stablecoin users' needs either. Empirical research finds that gateway stablecoin holders hold them for hedging purposes against cryptocurrency. So they are much more of an investment instrument to them rather than money or for payment. And it is queried whether these particular more limited, narrower functions could actually be treated in a different way for the purposes of regulation so that gateway stablecoin issuers and the industry would not find MiCAR to be so disincentivizing to them. Before I return to this slide, I would just say that the current developments for gateway stablecoins is that many of the large popular gateway stablecoins that are in existence for cryptocurrency holders are shunning the EU market as a result of citing difficulties with complying with MiCAR. So Tether, for example, is phasing out its EuroPEC token. And there is an on-chain stablecoin developed by a decentralized autonomous organization called Maker DAO. That stablecoin, previously called DAI, which has now changed its name to USDS, is also no longer accessible to residents in Europe. And the DAI token is being replaced so that the new token would not face compliance issues with MiCAR. And Binance will also see support for the BUSD, which is its own stablecoin, citing difficulties again with MiCAR. So the most popular stablecoin that has currently continued to function and is able to be offered to European residents is the Euro version of the USDC, which has been approved by the French regulator and is issued by Circle, which is a US-based firm. So I'm not saying that just because industry shuns MiCAR, MiCAR will certainly have to, turn over backwards in order to adjust itself to them. But it is a moment for reflection. And in terms of regulatory design, there is a question whether some of the more limited characteristics of gateway stablecoins can be regulated differently. For example, through more mandatory disclosure in terms of their characteristics and their functions and their promises to users, as well as thinking about whether governance-based regulation incorporating more user empowerment into the governance of how these gateway stablecoins are being issued and used, whether users should be more involved in some of the policies, which is showcased in the example of Maker DAO's governance of the stablecoin USDS. So these are some examples of alternative forms of regulatory design that might be more flexible, that might not constrain stablecoin issuers to very prescriptive forms of regulation. And bearing in mind that because users desire relative and not absolute stability, there is a question of whether we really need to have such conservative forms of reserve regulation. And it could be that regulation for stablecoins can be designed more in accordance with typology or on a sliding scale, so that where gateway stablecoins may morph into something more conventional or offered to the mainstream, then the public interest concerns regarding payment and absolute stability in value may then bite, introducing the opportunity to be subject to forms of regulation that are more consistent with payment services and instruments, that purport to represent monetary claims. So it could be something to think about in terms of building in more flexibility and more sensitivity to industry needs. And so finally, in conclusion, often regulation can enable and make markets, as we have seen in the example of PSD2. However, I think MiCAR's position on global stablecoins, disincentivize that innovation as well as turn away many of the other gateway stablecoin innovations from this market. And although we might say that the central bank digital currency is a much better alternative to privately issued global stablecoins, probably this defense is a good thing. We might weed the global stablecoin out altogether. But yet we have to think about what we might lose in terms of innovation. And CBDCs will always be fragmented along different jurisdiction lines, whereas global stablecoins can potentially bring about some sort of privately fostered convergence. So this presentation is not about just critically taking apart MiCAR's regulation for global stablecoins, but really posing some questions about the balances that we can further think about in relation to industry needs, in relation to the sort of innovation that we want to keep an open mind to, and being able to reflect on critical shortcomings that might disincentivize industry from moving further and might have innovation stifling effects. So thank you very much, Professor Zatti and Barassi, for inviting me to give this presentation. I think I might have gone a little bit over time, but back to you, and I'll stop sharing my screen.
Iris, great. Also, you are in time perfectly. It's very strange in Italy. We are perfectly in time because it's 4 o'clock. So a lot of questions. Thank you, Iris. I was hearing among some troubles that we have in the technical team, and I was wondering, you thought of a global stablecoin. Why do you think the need to have a global stablecoin? I mean, obviously, stablecoin, for the reason why it was thought, is naturally global. But I mean, you also can think about regional stablecoin. Why a global stablecoin? What do you think about?
Right. The global stablecoin is the definition that the FSB adopted. For any stablecoin that has cross-jurisdictional transfer possibilities, they call it global. But I perfectly agree with you that it can be regional, but it's still cross-border. And when you have something that's regional, that has the capability of being cross-border, there is no stopping how far cross-border it can grow and it can go. So I think the global stablecoin is not a bad description of something that is not purely domestic. I think if you think about it that way. And in terms of what use there is, I mean, I know that an often, offered critique is that because money is a public good and the central bank's provision of money has been the most stable, development over the last decades, centuries. And so why is there a need for privately issued money? I think the only thing I can say about this is that we cannot completely foretell how this will be used. I think the only thing we have to maintain is a very open mind for innovation. And I can see that peer-to-peer type transactions could very well run on this sort of privately issued money. And peer-to-peer transactions may very well also be faster, although we could say permissionless blockchains are not faster than RTGS, for example, and that I acknowledge. But I think that if you foreclose this area of innovation, if you say there is no point thinking about privately issued monetary claims, for example, and money just has to be a public good, the unit of count, the medium of exchange, the store of value are all public goods. There is no point thinking about the privately issued global stablecoin. I would then say we don't know what use cases it can be put to and how our minds can be open. So